Hi, David Bassanese here, Chief Economist at Betashares. This is a snapshot of my latest market trends report. And just reviewing the month of September, really the notable feature has been a big increase in longer term bond yields in many countries. And the US 10-year government bond yields, for example, lifted almost 0.5% to 4.57%. In Australia, also almost 0.5% increase in 10-year bond yields to about 4.48%. And this has come without much of an increase in short-run monetary policy tightening expectations. So the shorter end of the yield curve sort of held in place, and it's really been a widening of longer-term bond yields. I guess on realisation that global growth is holding up pretty well in the absence of a global recession anytime soon. It means that central banks aren't likely to cut interest rates in the first half of next year, or possibly at all in 2024, as markets were sort of starting to count on. So that sell-off in bond yields put downward pressure on equity prices. So we saw the global MSCI equity index down 3.5%. The ASX market also down around about 3.5% in the month. And bond yields had a particularly negative effect on equity prices because as I've been pointing out in recent months, the equity risk premium in markets is pretty tight. PE ratios are high at a time when bond yields are still relatively high. The rally in prices that we've seen in equity markets since late last year has pushed up PE valuations, and with interest rates staying high or bond yields staying high, it's pushed down the so-called equity risk premium of markets. So the equity market was vulnerable to a further increase in bond yields, and we certainly saw that come through in September. Looking through some thematics, you would expect, the technology sector globally was among the hardest hit sectors. It's more sensitive to interest rates. Also, areas like listed property also harder hit by the decline in interest rates. Credit spreads holding up okay. So we saw overall bond yields rise, but the corporate bond part of the market holding up okay as fear of recession have been easing. So we'll see how it plays out. I mean, I think that the sell-off in bond yields is probably a little bit overdone, given that global inflation is still, certainly underlying inflation is still trending lower, and most central banks I still think are likely done in raising rates. They may not cut rates anytime soon, but further significant interest rate increases seem unlikely. One wrinkle to that will be the lift in oil prices we've seen of late, and there will be some concerns about will that flow through to headline inflation, and will central banks feel the need to respond to that? At this stage, I don't think they will, but I guess the oil price is the new sort of concern that markets will need to digest in coming months. That's it from me now. Thanks for watching. If you'd like to see the full report, please visit the Insights section of our website. And I do point out we have a much more detailed market trends report now to look at. So certainly avail yourself of that and visit the Insights section of the website. Thanks for now, and I'll see you again next month.